Naming beneficiaries on your financial accounts is incredibly important. Equally important is reviewing those designations occasionally and keeping them up to date. In this video, we'll take a quick look at why doing this is so important and share some tips to help you understand your options before making any decisions. Hi, I'm Jared with Carlin Financial Group. For the best information to help make sure you don't outlive your money in retirement, be sure you subscribe to our channel and hit the bell to be notified when we post new videos. By naming beneficiaries to your financial accounts, you choose the type of legacy you wish to leave and to whom. If you have a well-crafted retirement plan, then there's a significant chance you could have money to leave on and will likely want to have some say into where it goes. When choosing a beneficiary, we normally choose someone who we expect to outlive us, though that may not always be the case. Beneficiary designations can include your spouse, your children, other family members, a friend, a trust, or even a charity. To make sure what you have left behind goes where you want, you need to designate beneficiaries and keep them up to date. Why is it important to keep them up to date? Well, marriage, divorce, births, deaths are all common reasons that beneficiary designations may need to change. Also, say someone you have named as a beneficiary has fallen out of favor. Sadly enough, that sometimes happens, and you haven't updated your beneficiary designations before you should pass. Well, that person would still be entitled to their share of your estate. In the unfortunate event that one of your beneficiaries predeceases you, there is some pre-planning you can do that we'll discuss in a minute, but it's always recommended that you update your designations as soon as possible to ensure your wishes are still clear and being observed. Another important reason for naming beneficiaries and making sure they remain current is that beneficiary designations on account documents normally supersede even a will. Financial assets that have a valid named beneficiary will likely pass directly to that beneficiary and avoid probate and other potential costly and time-consuming legal proceedings. It's also important to be aware of the age of who you might be leaving money to. For instance, many financial institutions will not pay directly to a minor child. Let's say your grandchildren are on the list of people you wish to potentially receive a share of your assets, but they're still minors when you pass away. If at that time the money's directed to them, that would lead to a probate court instead of avoiding one. And the court would likely have to establish a guardianship of some sort for the child in order for the funds to be received on their behalf. If you have questions about naming your beneficiaries and we don't answer them for you in this video, just leave us a comment down below and we'll do our best to address it in the future. Now that we've covered those basics, let's take a look at some of the terminology involved in selecting a beneficiary and make sure you understand it. Firstly, let's take a look at primary versus contingent beneficiaries. Your account should allow you to name both and spell out how you want things distributed. Your primary beneficiary is the first in line to receive what you leave behind. Typically, married couples will name their spouse as their primary beneficiaries, though sometimes that may not be the case. For certain financial instruments, if the spouse isn't named as the primary beneficiary, the law may require they be made aware of it and consent to that fact. When naming a spouse, 100% will typically go to that individual, but say that you're not married or your spouse has already passed and you may want to name your 3 adult kids as your primary beneficiaries and ensure they each get an equal share. You can do just that and stipulate that each receive a third of what you want to leave on. Contingent beneficiaries are second in line to inherit your remaining assets. Should your primary beneficiary be deceased or disclaim the inheritance at the time of your death, then that inheritance would pass to the contingent beneficiaries. Let's say I was my wife's primary beneficiary and we had kids, and the kids were contingent beneficiaries. If I passed away before she did and she hadn't changed her designations, or if we die together, the kids would receive the money upon her passing. We certainly recommend naming contingent beneficiaries whenever possible to help avoid probate and to clarify your wishes. But do be cognizant of who you name. As we discussed, you may not want to name a minor child, but rather maybe an adult that could help care and provide for the child with what you would leave behind. Now let's take a look at your distribution options and help you understand what they mean. The default distribution method is known as the per capita method. Under this method, you leave everything to the primary beneficiaries, meaning if one or more primary beneficiaries is no longer alive at the time your estate is distributed, the remaining portion would be split equally among the remaining primary beneficiaries. So if we look at an example of a family that we'll call the Smiths, John and Jane were married and had named each other as their primary beneficiaries. Sadly, John has already passed. When he did, all of his assets passed to Jane. Jane then did the advisable thing and promptly updated her beneficiary designations, removing John as her primary and replacing him with their 3 children who'd been her contingent beneficiaries, with each receiving an equal share. Jane then added her 5 adult grandchildren as the new contingent beneficiaries. Under the per capita method, let's say that Jane were to pass away in a car accident with her son Tom. Now remember, this method, all of the money goes to the primary beneficiaries, meaning that her 2 other sons, Richard and Harry, would split it 50-50. Tom's children would not be entitled to what was to be his share and would effectively be disinherited. Now, there are a number of reasons that this method could be perfectly valid for Jane to achieve certain goals. If, let's say, she wanted to be sure that what she left on stays just within the next generation, this is an effective method of ensuring that. Or maybe if, instead of adults, we assume Tom's kids had been minors, and so Jane preferred that their uncles be given the funds to help care for them instead of trying to leave money to them and having it lead to probate court and guardianship or other arrangements. It could also be an option if she loved Tom but didn't like the idea of his kids, who she was not as fond of, getting any of her money instead of her own children. All perfectly viable reasons. If, however, Jane wanted to avoid potentially disinheriting one or more branches of her family and wished the money to continue down the generational bloodline, then she could elect what is known as the per stirpes, which is Latin for by branch or by root option. In the same scenario, had Jane elected per stirpes distribution, instead of Tom's family being disinherited, his 2 children would split his third of the inheritance, each receiving 1/6 of the overall total. Note that the money would not pass on to Tom's wife, since she is not directly in the bloodline, but only to his children. Adding the per stirpes designation to a primary beneficiary may not be needed if that beneficiary is your spouse and you share heirs. By listing contingent beneficiaries that are your children after your spouse as your primary, you no longer need the primary beneficiary to be per stirpes because his or her children have already been named as your secondary beneficiaries as well. If, however, you're part of a blended family or your primary beneficiary is someone other than your spouse, it may be advantageous to add this provision to your primary beneficiary. We hope this has helped you develop a better understanding of your options when it comes to naming beneficiaries so that you can be certain your legacy is what you want it to be and your assets are distributed as you wish. If you'd like help ensuring that your beneficiaries are set up to match your wishes, you can find out more about becoming a client and apply using the link down below in the description. Thanks for watching today. Please like and share this video, and don't forget to subscribe and hit the bell so you won't miss out on any of our other tips. And remember, live today, plan for tomorrow.